Jurrien, your expectations here, do you think that they will reach a deal, and does that figure at all into your view of the market next year?
My assumption is that, the market's sort of on pins and needles, thinking that this is like a game of chicken, kind of like the movie American Graffiti, two teenagers playing a game of chicken, and the unintended consequences can be enormous, and of course they can. My sense is that the U.S. is playing a very deliberate long game here, and that this is not going to go away anytime soon. That this is one battle in a longer, period of trade tension. So I'm not assuming that there will be a deal that will put this whole thing behind us. And so, when you look at the 2019 earnings estimates, they're already drifting lower as they typically do. And I think there's some downside risk to that. Right now the street is looking at 10% growth. I think it could be more like 5 or 7%. And fortunately, the PE ratio of the S&P already reflects a lot of uncertainty. But I think there is some downside risk because, as Liz Ann said, there is a price to be paid. Either consumers are going to pay more for goods because of the tariffs if they get passed on by companies, or profit margins are going to decline if companies cannot pass them on. Either way, it's not just Chinese companies that are going to pay the price. There will be a price to pay for everyone, and that will probably be reflected in the earnings numbers for next year.
Liz Ann, when the Commerce Secretary Wilbur Ross comes on CNBC and says the press is blowing worries about a potential slowdown out of proportion, you think what?
Well, we're already seeing a bit of a slowdown. You saw 4.2 in the second quarter, 3.5 in this quarter. I think you're at about 2.5, 2.6 based on Atlanta Fed's GDP, and then you're getting closer down to the 2% range in 2019. So that's just looking at consensus numbers. To the extent that there's relevance between those and reality, then the slowdown has happened. And we also know that the pickup in growth in the second quarter had a lot to do with front-running activity in advance of the tariffs. One other point I want to make to Timmer's thing on earnings is that the other factor that's not yet baked into 2019 earnings has been the collapse in oil prices. You haven't yet seen analysts ratchet down estimates for 2019 earnings for that piece. So you could see a haircut to earnings having nothing to do with tariffs and much more to do with what's happened in the energy space.
All right. Finally, Jurrien, quickly, JP Morgan Asset Management today says overweight cash and treasuries. The cash is a better play than stocks for the first time in a decade. Are you that far?
I don't think cash is a better, better play than stocks. I mean, if we get 7% earnings growth next year, markets trading at a 16 multiple, the Fed, let's say it does 2 or 3 more hikes and then it sort of slows down or pauses. That's not a bad outcome. That's a high single-digit return for the stock market, and if PEs expand as they typically do if the market rises, you could even get 10 or low double digits. So that's obviously going to beat cash. I think the bigger question is, how do you diversify your portfolio? Do you do it with long bonds or cash? And obviously, long bonds have been the huge winner since the financial crisis. Creating a return of about 5% with a strongly negative correlation to equities. Maybe cash starts to compete with that as we go forward. That's my sense.